Imagine standing in the middle of a crowded marketplace in March 2026, where everyone is cheering because the Federal Reserve just announced a pause in interest rate hikes at 3.5%. You see headlines screaming about stability and the end of the aggressive tightening cycle that has haunted the American consumer for months. However, while the news anchors celebrate this supposed plateau, your bank account tells a much darker and more visceral story of survival. Why does the Federal Reserve holding rates steady feel like a victory for the economy but a silent death sentence for your personal savings account? We have been conditioned to believe that a pause is a reprieve, a moment to breathe. But in reality, it is more like being trapped in a room where the oxygen is slowly being depleted while the exits remain locked. This is the ultimate financial illusion where the lack of movement at the top creates a crushing weight at the bottom for the average person living paycheck to paycheck. The sugar-coated mousetrap of the current economic climate is built on the false promise that if the cost of borrowing stops going up, your financial struggle will naturally begin to trend downward. You are likely staring at your credit card statement right now, seeing an interest rate exceeding 21%, and wondering why the price of eggs and gasoline continues to erode your purchasing power despite the official stabilization. This disconnect exists because the high plateau of interest rates is not a safety net, but rather a grinding stone that slowly pulverizes the wealth of those who do not understand the underlying mechanics of debt. We are entering a phase of financial attrition where the invisible thief of inflation remains stubborn and the weight of existing debt becomes a permanent anchor. In this video, we are going to peel back the layers of this psychological deception and reveal why staying still is actually the fastest way to lose everything in this new era of permanent high costs. What is truly and silently controlling your wallet in an economy where inflation has become a stubborn ghost that refuses to leave the room? To understand why you feel poorer despite the Federal Reserve holding interest rates at the 3.5% to 3.75% range, we must look at the psychological phenomenon known as inflationary adaptation. Humans are remarkably resilient creatures. But this resilience is a double-edged sword when it comes to financial survival because we quickly normalize higher prices for gasoline and electricity. According to data from the Federal Reserve and Trading Economics in March 2026, energy costs have become the primary driver of persistent inflation, creating a sticky floor that prevents the cost of living from dropping even as borrowing costs stabilize. You might think you are making conscious choices, but your brain is actually falling into a dopamine trap where the temporary relief of a purchase masks the long-term erosion of your purchasing power. The internal mechanism of this crisis is not a lack of willpower or a failure of character, but rather a systemic flaw in how we perceive the value of money over time. When the Fed keeps rates high, they are trying to cool down the economy by making money more expensive to move. Yet, the average consumer continues to use high-interest credit cards to maintain a lifestyle that was funded by cheaper debt years ago. This creates a massive psychological friction where you are fighting against a tide of 21% interest on your revolving balances, while the broader economy sits at a 3.5% benchmark. You are essentially paying a massive premium for the illusion of normalcy, while the underlying structural costs of energy and logistics continue to eat away at your margins. This is the hidden architecture of the modern debt trap, where the middle class is squeezed between a high-interest plateau and a rising cost of basic necessities. The reality of the 2026 economic landscape is that the system is designed to benefit those who can provide liquidity, not those who are forced to consume it at any price. By understanding that your financial anxiety is a rational response to an irrational market structure, you can begin to detach your self-worth from your balance sheet and start looking at the cold, hard numbers. The Federal Reserve is not coming to save you with a sudden rate cut, because they are terrified of a second wave of inflation driven by volatile global energy markets that could spiral out of control. This means the environment of high costs and expensive borrowing is the new permanent reality for the foreseeable future. And your survival depends on recognizing this shift before your reserves are completely depleted. We have spent too long blaming ourselves for the weight of the world when the problem is actually the heavy machinery of the financial system grinding against our personal interests. Every time you swipe that card or pay an inflated utility bill, you are participating in a forced redistribution of wealth from the individual to the institutional level. The stubbornness of the current inflation cycle is a clear signal that the old rules of thumb regarding savings and spending are no longer sufficient to protect your future. We must confront the fact that the economic engine has changed its fuel source, and the cost of keeping your life running at the same speed is significantly higher than it was just a few years ago. If you continue to play by the rules of 2020 inches the year 2026, you are essentially trying to win a game that has already been reprogrammed against you. The question is no longer whether things will go back to the way they were, but how you will retool your entire financial strategy to thrive in a world where the floor is much higher than the ceiling used to be. The Federal Reserve has signaled a hold at 3.5 to 3.75%, which is the heartbeat of the global economy in March 2026. Yet, the number on your credit card statement is likely 21% or higher, and this massive gap is the predatory profit margin that keeps the financial machinery running at your expense. When you carry a balance of $5,000 at 21% annual percentage rate, you are paying over $1,000 a year just for the privilege of owing money. That is nearly $85 every single month that vanishes before you even buy a single gallon of gas or a loaf of bread. This is the friction that prevents any upward mobility because your engine is running at full speed just to overcome the drag of high-interest debt that never seems to decrease, regardless of how much you earn. Looking at the other side of the ledger reveals where the opportunity lies in March 2026, because for the first time in a decade, the high interest rate environment has made cash a productive asset if you know where to park it. While your standard checking account might offer a pathetic 0.01% interest, money market funds at institutions like Vanguard or Fidelity are currently yielding close to the federal funds rate. If you have $10,000 sitting in a traditional bank, you are essentially losing hundreds of dollars in potential earnings every year to the invisible tax of inflation and opportunity cost. The math is simple but brutal, because the difference between earning 4% on your cash and paying 21% on your debt is a massive swing in your net worth every year that compounds over time. The true mechanics of wealth in this plateau economy depend on understanding the power of capital scale and the relentless logic of compounded figures that work for or against you. When you reach a point where your liquid assets are generating enough yield to cover your basic monthly expenses, you have achieved a level of escape velocity that most people never even visualize. Imagine a scenario where your emergency fund is parked in a high-yield money market account earning 4%, while you aggressively pay down that 21% debt with every spare dollar. You are effectively navigating the system by stopping the bleed and starting the growth simultaneously, which is a strategy utilized by the wealthiest investors in the United States to maintain their dominance. This is not just about saving pennies or cutting out your morning coffee, but about re-engineering the flow of every dollar that enters your life. To change the game, you must look at the hidden costs that are not printed on your bank statement or advertised by your financial institution during their marketing campaigns. Every time you choose to keep a balance on a credit card while having cash in a low-interest savings account, you are making a mathematical error that costs you more than any market crash or economic downturn ever could. The compounded effect of 21% interest is a mathematical force of nature that works with the same relentless logic as gravity or the laws of physics. If you do not fight it with the same intensity, you will remain grounded forever, regardless of how hard you work or how much your salary increases every year. The shift from being a victim of interest to a beneficiary of interest is the single most important transition you will ever make in your financial life. Consider the long-term impact of these choices over a 5-year period, where the difference in net worth can amount to tens of thousands of dollars for the average household. The core math that will change your financial game is the realization that your debt is the bank's most profitable asset, and your savings are their cheapest source of capital. By flipping this script and demanding a higher return on your cash while refusing to pay a premium for consumer credit, you are effectively reclaiming your labor from the financial system. This mathematical pivot is the bridge between survival and prosperity, because it allows you to stop trading your time for money and start using your money to buy back your time. Once you master this simple calculation, the fear of the Federal Reserve and their interest rate decisions begins to fade into the background as you focus on the only interest rate that truly matters. The difference between a scarcity mindset and a strategic mindset in 2026 begins with how you perceive the Federal Reserve's pause at 3.5%. While most people are paralyzed by the fear that their purchasing power is being eroded by these persistent rates, the strategic thinker views this period as a necessary cleansing of the financial system that rewards those with discipline. This shift in perspective allows you to move away from the victim mentality that blames external economic forces and instead focus on the internal variables you can actually control in your daily life. Wealthy individuals do not wait for the economy to become favorable or for interest rates to return to zero before they make a move. They adapt their strategy to the existing conditions to ensure they are always on the right side of the interest rate spread. Redefining what it means to be wealthy in this high-cost era requires a complete departure from the visual cues of status that have misled the middle class for decades. True wealth in March 2026 is not measured by the luxury vehicle parked in the driveway or the designer labels in the closet, but by the volume of cash-flowing assets that produce income regardless of your physical labor. When you choose to invest in an S&P 500 index fund or a high-yield money market account instead of financing a depreciating asset, you are making a strategic decision to prioritize your future autonomy over current social validation. This is the fundamental difference between those who are rich in appearance and those who are truly wealthy in substance, because one relies on the approval of others while the other relies on the compounding power of capital. The opportunity cost of waiting for a return to normalcy is the most expensive mistake you can make in the current economic landscape. Many people are currently sitting on the sidelines, holding their breath for a rate cut that may not come for several years due to the stubborn nature of energy-driven inflation. By refusing to act until the environment is perfect, you are essentially surrendering your greatest asset, which is the time value of your money. The strategic mindset understands that a dollar invested today at a 4% yield is far more valuable than a dollar earned tomorrow in a lower interest environment because of the head start it gives your compounding engine. You must stop viewing your financial decisions as a series of isolated events and start seeing them as a continuous stream of choices that either build your fortress or tear it down. Buying back your freedom through temporary discomfort is the hallmark of the elite psychological approach to wealth management in the mid-2020s. This means making decisions that look poor or restrictive in the present, such as keeping an older car or living in a smaller home, so that you can allocate every available cent toward acquiring your independence. In a world where everyone is chasing the next dopamine hit from a new purchase, the person who finds satisfaction in watching their brokerage account grow is the one who will ultimately own their time. This shift from a consumer mindset to a capitalist mindset is what allows you to escape the gravity of the paycheck-to-paycheck cycle. You are not just saving money, you are purchasing blocks of your future life that will no longer belong to an employer or a banking institution. The psychology of the long game involves a radical acceptance of the fact that the path to wealth is often boring, repetitive, and entirely devoid of the excitement portrayed in Hollywood movies. While the media focuses on the volatility of the stock market or the latest decision by the Federal Open Market Committee, the successful investor focuses on the consistency of their contributions and the optimization of their tax liabilities. The current high interest plateau is actually a gift for those who have a long-term horizon because it allows for the accumulation of assets at a more rational valuation than the bubble years of the past. If you can master your emotions and stay committed to the math during these periods of stagnation, you will find yourself in a position of overwhelming strength when the cycle eventually turns. Ultimately, the shift from a scarcity mindset to a strategic one is about recognizing that you are the CEO of your own financial life. You cannot control the price of crude oil or the decisions of the Internal Revenue Service, but you can control your savings rate, your asset allocation, and your reaction to market noise. By internalizing the principles of behavioral economics and understanding how your own brain is wired to seek short-term comfort over long-term security, you can build a system that protects you from your own worst impulses. This level of self-awareness is the true secret of the wealthy, and it is more valuable than any hot stock tip or economic forecast because it remains effective regardless of what the Federal Reserve decides to do in their next meeting. The first and most critical move you must make immediately after finishing this video is a surgical strike on your high-interest debt using the debt avalanche method. This is not a strategy based on emotional wins, but on the cold mathematical reality of 21% credit card interest versus the federal benchmark of 3.75%. You need to list every single debt you owe from the highest interest rate to the lowest and redirect every surplus dollar toward the account at the very top of that list, while maintaining minimum payments on all other obligations. This strategy effectively minimizes the total interest paid to predatory financial institutions and significantly accelerates the timeline to your financial independence by removing the heaviest weights from your ankles first. In the economic climate of 2026, where the Federal Reserve is holding rates steady, the cost of delaying this action is a direct and permanent transfer of your future wealth to banking corporations. The second immediate action is the optimization of your cash reserves by moving them out of traditional checking accounts that offer virtually zero return on your deposits. You should look toward money market funds or high-yield savings accounts offered by reputable firms like Vanguard or Fidelity, which are currently tracking the federal funds rate of 3.5 to 3.75%. This simple electronic transfer transforms your stagnant emergency fund into a productive asset that works for you 24 hours a day without any additional risk to your principal. By ensuring that your liquid capital is earning a yield that matches or exceeds the core inflation rate, you effectively stop the silent erosion of your purchasing power that occurs when money sits idle in a standard bank. This is the simplest way to join the ranks of the wealthy who understand that every dollar must be an employee working to earn more dollars. Finally, you must automate your financial discipline by creating a systematic investment plan that treats your future self as your most important creditor. Set up a recurring transfer from your primary income source to a low-cost S&P 500 index fund or a tax-advantaged account like a Roth IRA or 401k to take advantage of the current market valuations during this interest rate plateau. In der Auflung. This step removes the psychological friction of deciding to save every month and replaces it with an unbreakable habit that accumulates wealth in the background of your daily life. Conducting a rigorous lifestyle audit to identify and eliminate recurring subscriptions or consumer habits that no longer serve your strategic goals will provide the necessary fuel for this wealth-building machine. These three actions combined create a defensive fortress around your finances, while simultaneously building the offensive capabilities needed to thrive when the economic tide eventually turns in your favor. The most dangerous moment in your financial journey is not when the economy is crashing, but when it finally begins to show signs of recovery or stabilization. As we look ahead from this March 2026 plateau, the greatest threat you face is the siren song of lifestyle inflation, which often triggers a massive wave of revenge spending the moment interest rates eventually begin to tick downward. When the media eventually shifts its narrative from fear to optimism, the psychological pressure to upgrade your lifestyle to match your peers will become an almost irresistible force that can undo years of disciplined saving and debt repayment in a single weekend of consumption. This is the final sugary mousetrap designed to catch those who have survived the high interest era but have not yet fully internalized the strategic mindset of the wealthy. You must realize that every time you increase your monthly expenses to match your increasing income or decreasing debt, you are effectively resetting the clock on your financial freedom and handing the keys to your life back to the banking institutions. We must now return to the image of that crowded marketplace we discussed at the very beginning of this journey, where everyone was cheering for a pause in interest rate hikes. Looking back with your new understanding, you can see that the majority of those people are still trapped in the same cycle of working for money that they have already spent on depreciating assets and high interest credit. The room is no longer suffocating for you because you have recognized the locked exits and have begun the hard work of forging your own key through mathematical discipline and psychological resilience. While others are waiting for the Federal Reserve to lower the cost of their debt, you are focused on maximizing the yield on your capital and eliminating the friction that previously held you back. The difference between the person you were at the start of this video and the person you are now is the realization that the federal funds rate is merely a weather pattern, while your personal financial strategy is the ship that determines your ultimate destination. The ultimate trap is the belief that you can out-earn a lack of financial philosophy or that a sudden change in government policy will solve your personal liquidity crisis. Even if the Fed were to drop rates to zero tomorrow, the person who lacks the discipline to avoid high-interest consumer credit and the wisdom to invest in productive assets like the S&P 500 would eventually find themselves back at the starting line. You must guard against the complacency that comes with a stabilizing economy by maintaining the same intensity and focus that you applied when things were at their worst. True wealth is not found in the ability to buy things, but in the ability to control your own time and say no to opportunities or obligations that do not align with your long-term vision. The high-interest plateau of 2026 is not a barrier to your success, but a training ground that is stripping away the inefficiencies in your life and forcing you to become a more capable and strategic version of yourself. As you move forward, keep the image of your compounding wealth in your mind as a shield against the temptations of the modern consumerist landscape that surrounds you. Remember that every dollar you save and invest is a freedom unit that will eventually work harder for you than you ever could for it. The journey from being a victim of the system to becoming a master of your own financial destiny is paved with small and often boring decisions that accumulate over time into an unstoppable force of nature. Do not let the noise of the headlines or the opinions of those who are still trapped in the cycle of debt distract you from the clear path we have outlined today. You have the tools, the math, and the mindset to thrive in any economic environment, provided you remain vigilant against the traps of your own ego and the allure of temporary status. The game has been changed. The rules have been revealed. And now the responsibility for the outcome rests entirely in your capable hands. The era of cheap money has ended, giving way to a new reality where discipline is the only true currency of value. In the year 2026, those who can navigate the high-interest plateau with a steady hand and a clear mind will find themselves in a position of unprecedented strength when the next cycle begins. Wealth is a marathon of the mind, and you have just taken the most important steps toward finishing the race on your own terms. stay focused, stay disciplined, and never forget that your financial freedom is the highest return on investment you will ever achieve in this life.